Thank you for joining me. I'm Alex, and I want to talk about Hamilton Beach. So it's an ancient company by today's standards, like around the turn of the last century. So today we kind of learn why it pays to pay close attention to the numbers and follow things when you're considering investing in something. So they make small appliances and other kitchen stuff and some other stuff, obviously. Also, a pretty small company with a market cap of just over a billion, obviously. Current price $19.15. Dividend yield is just under 2% with a payout ratio of 18%, which is pretty amazing. Revenue $613 million, which is down from $743 million. Earnings negative $3.5 million, which is down from $22 million. And they currently have a PE of 9. Forward PE is unlisted because no one really benchmarks these companies. So there's no big company putting out a forecast of their next year's earnings. Total assets, $303 million. Total liabilities, $248 million, which gives them a total stockholders' equity of $55 million. So balance sheet also not great. And why it pays to pay close attention is revenue doesn't seem too bad. So it dropped 20-ish%. But the revenue of 750-ish million was pretty consistent for the previous 4 years. So having the revenue drop that significantly after being that consistent is a pretty huge red flag. So trailing 12-month revenue is even lower. The earnings are actually positive. So that is a pretty good sign, and maybe they can turn things around, but it pays to really look into a company if you consider investing in them. And with a company like this, where the revenue just suddenly dropped by a quite significant amount, I think it pays to really do some risk analysis and to make sure you have a well-diversified portfolio. In other words, don't throw all of your eggs into a basket like this. So for a growth investor, obviously negative growth doesn't really track well. For a dividend investor, I think it's pretty interesting company, especially if they can keep the dividend going or maybe even raise it. Theoretically, with a payout ratio of 18%, there's much room to grow the dividend. But again, it all depends on the earnings and where things go from here. For a value investor, I think pretty much everything looks good on paper except for the declining revenue. The balance sheet is not great, but it's also not absolutely terrible. So obviously growth investors are out, and for dividend and value investors, it really pays to look into it, and it really pays to make sure that you don't throw too much of your portfolio into a company like this. I personally don't think that I would invest in a company like this right now. And they report earnings on the December 31st. So, or rather, their year ends December 31st. So I would probably want to wait until they report the full year earnings. Overall, I'm definitely not investing in this, but on paper, it looks interesting. That's it for me for today. If you like this video, make sure to subscribe. I'm coming out with more videos every day before market open. I hope you have a successful day.